On June 5th of the current year, Sewell Enterprises sold goods to a customer for $9,500 with a credit term of 210 net 30, means if the payment is made within 10 days, 2% off would be given, otherwise pay full by 30th. Sewell uses gross method of accounting for sales discount. The customer returned 2,000 of goods on June 6th, immediately after the purchase, next day, which means out of 9,500, 200 has been returned. So that means 7,500 is what you should receive. But customer makes the payment on 8th June, which means he is entitled to 2% off. So what you will collect less 2% means simply multiply this amount with 98%, because 2% would be given as a discount. So if you do, what you get is a simple 7350, and that is D. Ignoring taxes, which of the following situations will cause the comprehensive income to decrease? We know comprehensive income has two components, the income statement and other comprehensive income. Collectively, these two are called the statement of comprehensive income, or just the comprehensive income. Now the question says, which of the following situation will cause the comprehensive income to decrease? Let us move in the reverse order. An unrealized gain on the available for sale security. Unrealized gain on available for sale security, it is shown in the other comprehensive income. Since it is the gain, it will increase the other comprehensive income, and increasing the other comprehensive income will cause the comprehensive income to increase. So we are looking for the decrease, so this is incorrect. The amortization of the accrual or actuarial pension loss. Pension accounting is not a part of your syllabus. Remember, I hope there were 4 points specifically mentioned which you need to show in other comprehensive income. One of them was the pension gains and losses. So if there is any pension amortization of any pension loss or any gain, it is released to the income statement. So if a loss is being amortized and it is being removed from the other comprehensive income, in that case other comprehensive income decreases, right, and it is charged to the income statement, which means within this comprehensive income, one element is decreasing, other is increasing, so the net impact upon the comprehensive income is nil. It is just that we are crediting other comprehensive income and debiting this loss to income statement. So one increase and decrease in overall results in no change in the overall comprehensive income. So this is incorrect. We are looking for the one where the comprehensive income decreases. B. Dividend payout to the company shareholders. Payment of dividend is charged against the retained earning. It has nothing to do with the income statement, nothing to do with the OCI. In other words, nothing to do with the comprehensive income. So B, C, D are not the right options. Then unrealized loss on the trading security. Now listen, unrealized loss on the trading security, it's a loss reported in the income statement. A decrease in income statement, net profit, will overall lower the comprehensive income, because comprehensive income is the sum of income statement and OCI. If income statement or net profit falls, that means there will be lower comprehensive income. So that would make A to be the correct option. At the end of year 9, Forsyth Incorporated has an asset with the financial statement basis of $1,500 and tax basis of $500. So this is the balance as per the financial reporting. This is the balance as per the tax accounting. The asset was purchased at the beginning of year 1. The asset has a useful life of 10 years, and Forsyth uses straight line depreciation for its income statement and accelerated depreciation for its tax records. The tax rate in year 1 through year 10 was 30%, and the enacted tax rate in year 11 and beyond is 35%. At the end of the year 10, when the asset is going to be removed from the books, from financial reporting as well as from tax accounting, Forsyth will record a journal entry including an entry to deferred tax liability of. Now listen to me very carefully. When you are charging more depreciation in tax accounting based on accelerated depreciation method, it means your taxable income is less, whereas the income shown in the financial reporting is more. Resultantly, you are paying less tax now, but later when the effect reverses, you will have to pay more tax in the future. So the difference between the asset value under financial reporting and the value under tax accounting is 1000 multiplied by the tax rate, that is 300. This $300 deferred tax liability which was created will be reversed subsequently. The entry at the end of the period on year 10, it will be deferred tax liability will be removed by debiting it, and income tax expense would be credited. Income tax expense credited with 300. So what you're going to do, journal entry would be to debit the tax liability and credit the income tax expense deferred. That makes A to be the correct option. A company prepares a document at the end of the accounting period after all adjusting entries are recorded. This document provides or proves that total debits are equal to total credits, and it is used in preparation of the financial statement. This statement is called what? First of all, you have a journal. From journal, entries are posted into the ledgers. From the ledgers, we extract a trial balance at the end of the year. That trial balance requires certain adjustments of accrual at the end of the period, quarter or year. Those adjusting entries for accruals, for depreciations, for prepayments, those adjustments are posted through journal ledger, through journal, and then after the adjustment, what you have is the adjusted trial balance, and this is what we use for drafting our financial statement. So the statement after the adjustment is called the adjusted trial balance. That makes D to be the correct option. Next, the book value per share. This is basically a part 2 topic studied in section A, financial statement analysis. Book value per share is equal to the common equity, total common equity, divided by the number of shares. You don't have to calculate this. It's just that the focus is on the common equity. What is common equity? Common stock, additional paid in capital. Then you may have some revenue reserves, some capital reserves, some retained earnings, some other comprehensive income. I'm sure you know the components of equity. We discuss in detail in the statement of changes in equity. Okay, now the question says the book value per share calculation of the corporation is usually significantly different from the market value of the stock selling price due to book value per share. We have calculated book value of equity by taking the common equity dividing with number of shares. It comes out to be $10, for example. Whereas right now the stock is selling at $50. So why the book value per share is less and why the market value of share is more? You should know. The reason being that in the US, under the US GAAP, assets are reported at original historical costs, of course, and they are depreciated or amortized. But the market will value those assets at the market value. So the book value is based upon the historical value of the asset, historical value of the equity. Whereas the market will take the price of the assets under the market value. So you will have a higher market price and the lower book value per share. So this is the reason. Use of historical cost in preparing financial statements. Historical cost means the value of the equity will be understated, will be at the historical cost. Hence book value per share would be less, market value would be more. So this is the reason why is it so. Next. A company purchased supplies costing $2,500 on January 1st, year 1. So you purchased supplies on 1st of January year 1 and recorded the transaction by debiting the supplies inventory account. And when you purchased the supplies, you made this entry, supplies inventory debit, 2,500, and you would have credited cash or you might have credited the account payable. Now, what happens? $1,000 of the supplies are still on hand at the end of the year, which means out of 2,500 you have used up 1,500, only 1,000 remains. So what you have used up, you must bring this into your accounting at the end of the year. You haven't, you should. On 31st of December, this is the entry you should make. You should reduce the supplies inventory by 1,500 by debiting the supplies expense account 1,500 and crediting the supplies inventory account with 1,500. Now you will have the balance of 1,000 of supplies that is available, right? So what you are going to do, this is what we should do. What the question says, the company accountant did not prepare the appropriate adjusting entries at the end of the accounting period. What effect will this have on the statement of financial position on December 31st year 1. Now, since you have just booked the asset at 2500, even it was used during the period, so resultantly you have a higher supplies inventory, so your assets are overstated. Your supplies inventory, which is an asset, it is overstated by 1500 because it has been used. So your inventory is high, supplies inventory, that means your current assets are higher. Why not BCD? Let us discuss. Equity will be understated by 1500, wrong. Since you did not charge the expense of 1500 supplies expense, so your profit is overstated. When your net profit is overstated, that means your equity is overstated, not understated. Equity will be overstated by 1000, it will be overstated by 1500, not 1000. Assets will be overstated by 1000, no. Asset would be overstated by 1500 because you use 1500 worth of supplies inventory, but you did not make the adjusting entry. So option B, C, D are incorrect, A is right. Next. Jenkins sells a refrigerator and warranty on the refrigerator to Carter for 45,000. You are selling two things simultaneously. You are selling a refrigerator and a warranty for a total of 4500. Now listen, it says the refrigerator alone is worth 40,000 and warranty is for 5 years and can be sold separately for 10,000. So they have separate values of 40 and 10, but collectively they are being sold for 45. Now, which of the following statement is most accurate in regard to this transaction? Now, listen to me very carefully. We have two items, refrigerator and warranty, and they are separately sold for 40 and 10,000 respectively. That means 50, but together they are being sold at 45. So how should we allocate the revenue? How should we split this 45 into two parts? The refrigerator sale and the warranty sale, separable warranty. Now, if you just look at these two amounts, 40 and 10, that is 50, 50, 40 by 15 to 100, this is the 80% of the total revenue, and this is the 20% amount of the total revenue. So, which means, if we are selling the refrigerator and warranty together for 45,000, that would mean that out of this 45, 80% would represent the sale of refrigerator and 20% would represent the sale of warranty. So it's going to be 9,000 for warranty and 80% of 4500, that's going to be 36,000 for the sale of refrigerator. So you're going to split 45 into 80 and 20%, reflecting the sale of warranty and the sale of refrigerator. So the contract price should be adjusted to 50. No. The warranty will represent 20% of the allocated contract price. I have solved it fully. This is true. Correct. The refrigerator and warranty together represents a single performance obligation. No, they are not a single performance obligation. They are two distinct performance obligation and separate, refrigerator and warranty. And the price of the contract will be allocated 10 to warranty and 35 to refrigerator. No, 9 to warranty and 36,000 to refrigerator. So you should have a good reason for rejecting the incorrect option and selecting the right one. It's a very straightforward question. All of the following are elements of an income statement except expenses is an item of income statement. Gains and losses are reported in income statement. Revenue is an element of income statement, but shareholder equity, this is an element of balance sheet shown in the statement of changes in equity. So that is B. B is the right answer. Next. A company has 100 million of debt that is due in March year 3. In December year 2, just 3 months before the debt is to be paid, the company entered into a non-cancelable agreement with its lender to refinance the debt with the same interest rate and with the full principal. Now, what happened before the debt was to be paid in March? We entered into a refinancing arrangement with the banker, which means this debt will now be paid in December year 5. This current liability, which is due within 3 months, has been refinanced and now it is to be paid after 3 years. That means it's no longer a current liability. How should the debt be classified on December year 2 balance sheet of the company? Since it has been refinanced, even it was due after 3 months, it will be reported as a non-current liability. So not a current liability, not considered as an off-balance sheet liability because it is on the balance sheet, on the face of balance sheet. It is not an off-balance sheet transaction. It is appearing on the balance sheet. it is classified as a contingent liability. It is not a contingent liability. It's not dependent upon any other outcome. In fact, it's a non-current or long-term liability because the debt has been refinanced. So that makes B to be the correct option.